morning and welcome to another edition of Friday's Financial Fitness. Today I want to continue our discussion from last week about the three forces affecting market volatility. And today I'd like to spend our time talking specifically about the Federal Reserve's monetary policy as well as their past actions of quantitative easing. The term monetary policy refers to the actions that the Federal Reserve undertakes to influence the amount of money as well as the amount of credit in the U.S. economy. Changes to the amount of money and credit affect interest rates, which is the cost of credit, and the performance of the U.S. economy. For example, if the cost of credit is increased, meaning the Fed raises rates, then fewer people and fewer companies will borrow money, and the economy could potentially slow down. The Fed really has three different tools at their disposal that they can use to influence the monetary policy. The first tool is referred to as the open market operations. What the open market operations is the Federal Reserve constantly buying and selling government securities in the financial markets, which in turn influences the level of reserves in the banking systems. These open market operations are the most common tool that the Fed has in monetary policy. An extension of the open market operation is called quantitative easing, or better known as QE. Quantitative easing was originally started in Japan back in the 1990s, and quantitative easing really is the government purchasing these securities in the open markets with the objective being to lower rates and increase the money supply. The main difference between quantitative easing versus just the straight open market operations is that quantitative easing can buy longer-term bonds. So the quantitative easing is considered when short-term interest rates are approaching zero and the Fed can't lower rates anymore. When the Federal Reserve Bank seeks to promote the economic growth, it buys government bonds, which ultimately lowers short-term interest rates and increases the money supply. This strategy, however, loses its effectiveness when interest rates are approaching zero. The quantitative easing was specifically started in November of 2008 when the government started buying mortgage-backed securities in the big recession with the real estate bubble. The quantitative easing continued until June of 2013 when Ben Bernanke, who was then the Federal Reserve Chairman, had indicated to the market that they were going to start tapering off with their quantitative easing. It ultimately came to a complete stop in October of 2014. This lack of intervention from the Federal Reserve in terms of the quantitative easing ultimately has created more volatility in the markets. The second tool that the Federal Reserve has is setting the discount rate. This discount rate is the rate that banks pay on short-term loans from the Federal Reserve Bank. Similar is the Fed funds rate. The Fed funds rate is what we continuously hear about in the media when they talk about the Fed raising or lowering interest rates. This Fed funds rate is simply the rate that the banks are borrowing money. So as the Fed potentially is raising these rates, that makes the rates that the banks pay for this money higher, and in turn, consumers and companies will have to pay more, ultimately leading them to not wanting to borrow as much money and potentially slowing down the economy. The third and last tool that the Federal Reserve has in terms of the monetary policy is in setting their reserve requirements. When we talk about setting the reserve requirements, it is really the amount of physical funds or monies that the banks have or institutions that they are required to hold in reserves against the deposits that they currently have in the bank or in the account. In other words, it determines how much money the banks can create through loans and investments. This requirement usually is around 10%, but the reserve requirement ensures that the deposit institutions and banks maintain a minimum amount of physical funds in their reserve. This certainly can have an effect on the overall volatility and ultimately the economy based on how much money the banks are able to lend out. Next week, I'm going to talk about the second component, which is our slowing global and U.S. economy, and how that is affecting the overall market volatility.